You opened a bank account expecting it to simply hold your money and keep it safe. Then one month you noticed your balance was a little lower than it should be, with no purchase to explain the difference. That quiet shrinkage was a bank fee. Banks charge many small fees, and most people never read the full list. Learning what these fees are, and what triggers them, is the first real step to keeping more of your own money. A bank fee is a charge the bank applies for using its services, or for breaking one of its account rules. Some fees pay for a service you actively chose, like a wire transfer or a replacement card. Others are penalties for something the bank does not like, such as letting your balance drop too low. Either way, the money comes straight out of your account, often quietly, and often without a separate bill arriving to warn you. This matters because fees are small individually but surprisingly heavy when added together. A few dollars here and a few dollars there can quietly grow into a meaningful amount over a single year. Worse, fees often land hardest on people who already have less money, because low balances and overdrafts are exactly what trigger many of them. Understanding fees is really about protecting the people who can least afford to lose anything. Banks make money in several different ways, and fees are one important piece of that. When you open an account, you agree to a long document that lists every possible charge the bank can apply. Most people never actually read it. The bank does not exactly hide the fees, but it does not highlight them either. They are simply applied automatically whenever a certain condition is met, and you only see the result much later. Imagine your account requires a minimum balance to stay free of charges. One month your balance dips below that line for just a few days, maybe because a bill landed early. The bank applies a maintenance fee anyway. That fee lowers your balance even further, which can make it harder to climb back above the minimum next month. A single small dip can quietly turn into a repeating monthly charge you never planned for. The most common mistake is assuming all accounts are simply free and never bothering to check. People sign up, ignore the paperwork, and only notice the fees when the balance starts to feel wrong. By that point, months of charges may have quietly passed. The fix is not complicated at all. It simply requires reading the fee schedule once and knowing exactly which conditions trigger a charge on your specific account. The hidden risk is the overdraft chain. If you spend more than you actually have, the bank may choose to cover it and charge you an overdraft fee for doing so. If several transactions clear on the same day, you can be charged that fee several times over. Each fee pushes you further below zero, which can then trigger even more fees. A small shortfall can snowball into a large and painful balance. Think of bank fees like a slow leak in a bucket. The bucket still holds water, so nothing looks obviously wrong at a quick glance. But drop by drop, the level keeps quietly falling. You can keep refilling the bucket again and again, and never quite understand why it never seems to stay full. The smart move is not to pour water in faster. It is to stop, look closely, and find the leak. Here is the key idea worth remembering. Most fees are avoidable, not mandatory. Maintenance fees often disappear entirely if you meet a balance or deposit requirement. Overdraft fees vanish if you simply keep a small cushion in the account. Out-of-network charges shrink if you use the right machines. Fees are almost always triggered by a specific condition, and conditions can be managed once you actually know what they are. Say your account charges a fee for using out-of-network cash machines. You notice it is quietly costing you a few dollars several times every month. So you make one small change. You withdraw a slightly larger amount, a little less often, and only from your own bank's machines. The behavior shift is tiny, but the recurring fee simply stops appearing. That is honestly how most fee problems get solved. Beginners often think the bank is doing them a kind favor by covering an overdraft. Sometimes it genuinely can help in an emergency, but it is not free generosity. It is really a very short, very expensive loan with a flat fee attached to it. Declining overdraft coverage on small everyday purchases is often the safer choice. A declined card is annoying for a single moment, but a fee tends to follow you much longer. There is a quiet psychology to fees. They are carefully designed to feel too small to fight over. A few dollars does not feel worth a phone call or an argument, so most people just shrug and move on with their day. The bank is genuinely counting on that shrug. But the shrug, repeated across millions of accounts every month, is the whole point. Your attention is the one thing fees quietly depend on. A practical rule is to always keep a buffer. Try to hold a small extra amount in your checking account that you mentally treat as completely untouchable. This quiet cushion absorbs timing mistakes before they ever become overdrafts. It is not invested money, and it is not spending money. It is simply a silent guard standing between you and a whole chain of fees you never wanted in the first place. Avoid accounts whose conditions you cannot realistically meet month after month. If an account needs a high minimum balance that you rarely keep, that account is simply not free for you. Avoid signing up for extra services that automatically add monthly charges you do not actually use. And avoid ignoring your statements entirely, because a statement is exactly where a new or rising fee first becomes visible to you. A better habit is a short, calm monthly review. Once a month, scan through your statement and look for any charge that is not a purchase you actually made. Then ask yourself what condition triggered it. If you cannot explain a fee, simply call the bank and ask them directly. Banks will sometimes reverse a first-time fee, and even when they do not, you learn exactly how to avoid the next one. Over many years, controlling fees has a real and visible effect on your finances. The money you keep stays in your account, where it can quietly support savings, reduce stress, and prevent overdraft spirals before they start. More importantly, the habit of reading terms and questioning charges tends to spread. People who learn to watch their bank fees usually start watching their other fees too, and that wider awareness protects them everywhere. So here is the short version. Bank fees are charges for services or penalties for breaking your account rules. They feel small in the moment, but they add up over time, and they tend to hit hardest exactly when money is already tight. Most of them are completely avoidable once you understand the conditions that trigger them. The fee schedule is boring to read, but reading it once is genuinely worth your time. A bank account should quietly work for you, not slowly drain you. Fees are not some unsolvable mystery, and they are not a punishment you simply have to accept forever. They are conditions, and conditions can always be managed once you see them clearly. Read the rules once, keep a small buffer in place, and review your statement every month. Do that, and the quiet leak finally stops, one drop at a time.